Most people think they understand how the economy works. They don't. Not because they're unintelligent, but because the economy they think exists is built on assumptions that quietly stopped being true. Assumptions that worked for decades, became institutionalized, and then slowly detached from reality. These beliefs feel safe. They sound logical. They're repeated by politicians, economists, and the media. But they're illusions, and believing them is exactly how people get blindsided when the economic regime changes. Today, we're breaking down the 5 economic illusions people still believe, and why each one is becoming more dangerous the longer it survives. Before we start, it's important to understand why they exist in the first place. Economic systems evolve slowly, but public understanding evolves even slower. Institutions are designed for continuity, not disruption. Policymakers, central banks, and governments are incentivized to preserve confidence even when the underlying structure is changing. Illusions form when past success is projected indefinitely into the future. Short-term policy fixes mask long-term deterioration. Complex systems are simplified into comforting narratives. Gradual decline feels like normal adjustment rather than structural change. Most people do not experience macroeconomic shifts directly. They experience them indirectly through higher rents, higher grocery bills, more debt, less job security, and rising inequality, often without a clear explanation of why these pressures are building. This disconnect allows outdated beliefs to survive long after reality has changed. Illusion number 1, the economy always recovers. This is the most comforting illusion of all. The belief that no matter how bad things get, the economy will eventually bounce back, because it always has. Historically, this belief was often correct. Recessions were followed by recoveries, financial crises were followed by expansions, GDP rose, unemployment fell, and living standards improved over time. But this belief hides a critical macroeconomic distinction. Not all recoveries restore the same economic reality. In macroeconomics, there is a difference between cyclical downturns and structural transitions. Cyclical downturns occur when demand temporarily collapses. Once demand returns, the economy resumes its prior growth path. Structural transitions permanently alter the growth path itself. When demographics age, when debt saturates, when productivity growth slows, when globalization reverses, or when political constraints tighten, recoveries do not restore the old trajectory. They lock in a new one. History repeatedly shows that economies can recover statistically while society never returns to its previous standard of living. Japan is the clearest case. After its asset bubble burst in the early 1990s, Japan avoided outright collapse. GDP stabilized, banks survived. The country never experienced mass unemployment. On paper, Japan recovered, but in reality, Japan entered 3 decades of stagnation. Wage growth flatlined. Productivity slowed. Younger generations faced limited opportunity. Asset prices never returned to their peaks. The economy recovered, but the old growth model never came back. Southern Europe, after the Eurozone crisis, tells a similar story. Countries like Italy, Greece, and Spain technically recovered after 2012. GDP stopped contracting, financial markets stabilized. But real incomes, employment quality, and productivity remained structurally weaker than before the crisis. Illusion number 2. Central banks are in control. For decades, central banks cultivated an image of technical mastery. They cut interest rates to stimulate growth. They raised rates to fight inflation. They intervened during crises to stabilize markets. This created the illusion that central banks could fine-tune the economy like engineers adjusting a machine. But central banks do not control the economy. They react to it, often late and always under constraint. Monetary policy operates with long and variable lags. Rate changes move unevenly through credit markets, housing, asset prices, labor markets, government finances. More importantly, high debt fundamentally changes monetary power. When debt levels are low, interest rates can rise without destabilizing the system. When debt levels are high, rate hikes threaten financial institutions, housing affordability, pension solvency, government budgets. This forces central banks into trade-offs. Inflation control competes with financial stability. Market discipline competes with systemic risk. Central banks have repeatedly appeared powerful right before losing control. In the 1970s, the US Federal Reserve believed it could manage inflation through modest tightening while preserving growth. Instead, inflation spiraled out of control, forcing Paul Volcker to trigger one of the most severe recessions in modern history to restore credibility. More recently, after the 2008 financial crisis, central banks relied on zero interest rates and quantitative easing. These policies stabilized markets, but they also inflated asset prices, encouraged leverage, and increased dependence on monetary support. By 2022, central banks discovered the limits of their power. Rapid tightening exposed banking fragility, sovereign stress, and market instability almost immediately. Rate hikes worked, but at the cost of financial stress. In high-debt systems, central banks become managers of fragility. Inflation is tolerated longer. Asset prices are supported more aggressively. Financial repression becomes implicit policy. The illusion is believing central banks are fully in control. The reality is they operate inside a narrowing corridor of acceptable choices, where every decision carries systemic risk. Illusion number 3, inflation is temporary. This illusion refuses to die. People are taught inflation is caused by temporary shocks, supply chain disruptions, energy price spikes, post-crisis demand surges. And once those shocks fade, prices normalize. Sometimes that happens. But inflation is not just a shock. It is a structural regime. Inflation behavior reflects deeper forces, labor supply dynamics, fiscal policy choices, trade structure, energy systems, geopolitical risk. Today's economy faces persistent inflationary drivers: aging population, shrinking labor supply, deglobalization, raising production costs, geopolitical fragmentation, disrupting trade, industrial policy, distorting efficiency, chronic fiscal deficits, rising defense and security spending. These forces do not disappear with time. They make inflation more volatile, more political, and harder to suppress without economic damage. The illusion is expecting inflation to revert cleanly to the low, stable environment of the past. That environment was the result of globalization, demographics, and debt expansion, conditions that no longer exist simultaneously. Inflation has a long history of overstaying its welcome. In the post-World War II period, many governments assumed inflation would subside naturally once wartime disruptions faded. Instead, inflation persisted for decades, gradually eroding purchasing power and forcing financial repression across developed economies. The 1970s provide an even clearer example. Inflation was initially blamed on oil shocks. Policymakers assumed prices would normalize once energy markets stabilized. They didn't. Inflation became embedded in wages, expectations, and fiscal policy. It took double-digit interest rates and a deep recession to finally break the cycle. Illusion. Number 4, debt doesn't matter as long as growth continues. This illusion sounds sophisticated. It's often phrased as, debt is manageable if growth exceeds interest costs. In theory, this is correct. In practice, it is fragile because it assumes stable growth, stable interest rates, political willingness to adjust budgets, continued investor confidence, absence of shocks. Debt becomes dangerous when interest expenses rise automatically, when deficits persist even during expansions, when borrowing funds consumption rather than productivity, when reform becomes politically impossible. Once debt reaches saturation, policy reverses roles. Instead of policy managing debt, debt begins managing policy. Governments drift toward financial repression, inflationary erosion of liabilities, forced domestic absorption of bonds, declining policy independence. The illusion is treating debt as neutral accounting. History is unforgiving when it comes to debt. The Roman Empire financed expansion through debasement and borrowing. Growth continued until currency credibility collapsed and economic complexity shrank. More recently, Greece entered the 2000s believing growth would outpace debt. Instead, rising interest costs and lost market confidence forced brutal austerity, wiping out decades of economic progress. Japan again provides a slower example. Government debt exceeded 200% of GDP without immediate crisis, but the price was permanent fiscal rigidity, suppressed growth, and reliance on central bank intervention. Debt rarely causes sudden collapse in advanced economies. It causes long-term stagnation, repression, and loss of flexibility. Illusion. Number 5. Globalization will always lower prices. For decades, globalization acted as a powerful disinflationary force. Cheap labor, efficient global supply chains, just-in-time production. This created the illusion that low prices were permanent. They weren't. Globalization was not a natural law. It was a political and strategic arrangement. That arrangement is now reversing. Trade wars, sanctions, export controls, national security concerns, and industrial policy are fragmenting the global economy into rival blocs. Supply chains are rebuilt for resilience, not efficiency. Redundancy replaces optimization. This raises baseline costs, reduces productivity growth, and makes prices more sensitive to shocks. Globalization is not permanent. History proves it. Before World War I, the world experienced a highly globalized era. Capital flowed freely, trade expanded, prices were stable. Many believed globalization was irreversible. World War I shattered that illusion. The interwar period saw protectionism, trade barriers, and economic nationalism return rapidly. Prices became volatile, growth slowed, political instability followed. More recently, the 1970s and 1980s saw partial deglobalization as countries protected industries and energy supplies. Inflation rose, productivity slowed, and costs increased. Globalization lowered prices when politics allowed it. History shows it reverses when security, nationalism, and power reassert themselves. So who benefits from those illusions? These illusions persist because they benefit powerful figures. They allow governments to delay painful reforms, institutions to preserve credibility, markets to underprice long-term risk, asset holders to benefit from stability narratives. Illusions reduce urgency and stretch timelines, but they also increase the eventual cost of adjustment. So how economic illusions finally break? Illusions rarely collapse overnight. They erode gradually, and then fail suddenly, usually through persistent inflation, fiscal stress, currency instability, social pressure, market dislocation. When illusions break, adaptation becomes expensive and chaotic. History shows this pattern repeating again and again. The goal is not pessimism, it is realism. A world with higher volatility, slower growth, More political intervention, tighter policy trade-offs is not the end of prosperity, but it is the end of autopilot. In this environment, resilience matters more than optimization. Balance sheets matter more than narratives. Systems thinking matters more than slogans. The economy isn't broken, but it is changing. And the greatest risk today isn't recession, inflation, or market volatility. It's believing the old rules still apply. The 5 economic illusions people still believe aren't foolish beliefs, they're outdated ones. And in periods of transition, outdated beliefs are the most expensive thing anyone can hold on to. If you want to understand how the global economy is actually changing, this channel breaks it down in a clear and simple way. Subscribe if you want to stay ahead of the shifts most people won't recognize until the consequences are already unavoidable.